Good afternoon to everyone here from Vienna, and good evening to our presenter from Australia and some participants I saw from Japan. Nevertheless, this is the seventh Methane Monday this year, and you are following, most of you, very closely, so you know that we are running for the fourth year, and interest is still huge, and we are grateful for that. Each time it's different topic. This time we will have focus on costs, actually, not on technology, not on reporting and mitigation, but more on the cost of all of that. As you can see here on the slide, so this is for October. We have pre-scheduled next Methane Monday on 10th of November. Will be more about certification. MIQ is going to deliver the presentation. And then we have planned for one more in December. Let's see what will be the topic and exact date. So today, as I already said, more about methods for estimating the cost of methane emissions abatement, and this is going to be done and delivered and explained by Mr. Bobby Chopra from DORIS Group, settled in Australia. So with that, I would say, Bobby, floor is yours, and I will stop to share my presentation.
Okay, Carolina, thank you very much for the introduction. As Carolina said, my name is Bobby Chopra. I work with DORIS, and I'm going to talk a bit about the practical methods for estimating the costs of methane emissions abatement. So just to give a very brief overview of DORIS themselves. So DORIS is a global company. We've got about 1,000 people worldwide. Roots are in engineering services. They've provided engineering study support for 6 decades now in Europe. And we've got our headquarters in Paris, and we're also located in 15 different countries. We've got 17 offices all over the world. And I'm not in the big circle in the middle there. I'm down in the bottom right in Perth. So one of our more remote locations, one of the smaller offices, but an office that we've really been doing a lot of work on methane in the last few years. As I said, we cover mainly engineering. That's kind of our DNA and our roots, but we've also branched out into consulting work, project management, technical assistance, and asset management, as you can see on this slide. With the consulting work, a lot of focus on greenhouse gas emissions management, decarbonisation and net zero strategies, as well as energy transition strategies and pre-feasibility studies. So yeah, we've been around for 60 years. We just actually celebrated our 60th anniversary in September. And we've started in conventional energies, oil and gas, but more recently, probably 20 years now, over 20 years, we've been working in offshore wind, and then now also in low carbon energies, as well as greenhouse gas emissions abatement, which is what I'm going to talk about today. So we've developed a repeatable approach for emissions estimation or emissions assessment. And the intent of that is really to support project decision making for decarbonisation projects by providing a practical means for being able to compare the various projects and their economics. So as Carolina said in the introduction, we will be talking a bit about cost, but those costs and estimates of technology solutions are part of an overall economic analysis, and that's really what underpins our methodology for emissions assessment. The differentiator being that with your economic modelling, the cost is one of the critical inputs, the CapEx, as is your emissions reduction potential, potential carbon taxes, the gas price you can get for your recovered gases. So there's quite a complex number of parameters which feed into the model and allow you to make some informed decisions. So there's a 4-step methodology. In the graphic on the right, you can see those 4 steps. And I'll go into each of those in a bit more detail shortly. So we have the discovery phase to start with, then technology, moving into opportunity cost, which I'll spend quite a bit of time in this presentation talking about that cost estimation and economic modeling. And finally, the panel of solutions. And that methodology is laid out in the 8 steps on the left there. I can show you in a bit more detail in this next graphic. So that first discovery phase is about data acquisition and geomapping, trying to understand where the key emissions locations are. So we've used this assessment tool on national assessment. So at a country level, it's really good to kind of have a macro view of potential key emitters and then being able to focus on those that contribute the biggest emissions to that country. For company level emissions, when you have inputs such as OGMP report data or companies' own in-house emissions estimation data, you can use those to geolocate and map the emitters. Really important to understand, where the sources are, whether there's any potential clustering, or if there's an approach to the technology solution where you can combine emission sources to aggregate them and put in an appropriate technology in to monetize the aggregated recovered emissions. That's just a couple of examples of how the geolocating can work. We also then, once we've identified the assets and the locations, we forecast the emissions using national energy reports or energy market analysis, or even at a company level, you would use production profiles, asset plans, and similar. In parallel to the discovery phase, phase 1, is the technology phase. So whilst we're identifying the key emitters, we're also screening and selecting the appropriate technologies that can be applied to those emission sources. So once you have identified the technologies and you've also identified the assets, you can map them together as a route to market to understand a case map of solution versus asset. And that brings us to the heart of this methodology, which is opportunity cost. So using our emissions forecast and using the technology solution, you can estimate your capital expenditure and your operating expenditure, your forecast carbon price, your forecast gas price, all feeds into the economic model. We use tools such as our internal cost database at DORIS, as well as, depending on the level of definition, of engineering definition, you can also use some other techniques such as industry metrics or vendor budget quotations. And I'll go into a bit more detail around those when we talk about phase 3 opportunity cost. And then the final phase is screening. So once you have your economic modeling complete, you're able to comparatively assess, compare each solution per asset on a consistent basis, which is really important. With any major development in oil and gas sector, you're always trying to bring a level playing field when you're choosing different development options. The same approach is how we apply our methodology to emissions reduction. You need a level playing field. You need to have a common set of economic assumptions, and the variable is then how you apply your technology to the asset, the cost of that technology and the operating cost of it over time. So once you have your option selection, it allows you to support your decision. Now, for data sources, we use a number of data sources depending on whether it's a national level assessment or a company level assessment. There's publicly available information such as the Climate Trace database, which is very useful for venting emissions from methane. OGMP is obviously a very good source for company level information. And the GFMR has excellent data, geolocated, annualized, estimated flaring emissions data. We benchmark those using the IEA, and we use companies such as Rystad for forecasting flaring emissions and venting emissions, actually. Once we have this data, we extract it, we load it, validate it, and aggregate it, and we put it into our tools to be able to visualize it. And I'll show you what the benefit of that visualization is. So here's an example here of just country level assessments around not quite Europe, but just to the east of Europe. You can see some of the former CIS countries and down to Iraq and Jordan here. So some of the benefits here is, as you can see in Iraq in particular, is you can have clusters. So the sizes of these bubbles is the size of the estimated methane emission. In Pakistan, similarly, you can see down here, there's some clustered emissions. You can see the volumes, they're quite close by. And that allows you, when you're doing your initial assessment and screening, to decide if there's potentially a solution that you can locate to allow you to aggregate and gather various emission sources into a common technology solution. In other areas, you can see there's quite a large spread, like in Kazakhstan here, you can see a reasonable geographical spread in those main emissions, but a very useful tool. And when we've mapped this at company level, similarly, you can get some insights that perhaps aren't as obviously available when you're just looking at the raw data. So once we've identified those key emitters, the next step is to produce a forecast of emissions from those key emitters. It's quite a busy kind of chart here, but these different colors indicate individual assets, and those assets build up. So this was a company level assessment that we performed. They build up to give you the shape, and the shape changes as the assets decline in production and emissions, and then new projects are brought on and tied back. And you can see how that varies and how there's a couple of sawtooth type profiles there. And that's really important when it comes to economic modeling, because obviously any carbon tax, any potential emissions reduction technologies will vary if the emissions vary as well. So we use those to kind of build detailed emissions estimates. We use things like national strategies, energy strategies, or company annual reports, company decarbonisation plans, to help understand the macro forecast for energy production. And ultimately, the objective is to find some common themes through here to see if there's significant contributions from an operator when we're doing national level assessments, or when we're doing company level assessments. It's quite interesting to understand if there's either a small number of assets that contribute the most material amount of emissions, or another interesting insight we've often found is if there's a particular emission type. For example, tank venting is quite common. If there's no vapor recovery units installed, then you can see that a significant portion of a company's emissions may be due to tank venting. And in those instances, there's potentially pilot schemes and modularized approaches you can have to reducing your emissions. So we've now got the assets, the key emitters, and we've also got the forecast emissions from those assets. So the next step is to screen for potential technology solutions. And you can see on the left of this slide, it's a fairly kind of logical 5-step priority process that we apply, favoring the most kind of favorable technology solution is the one where you can stop at source. So if you can stop the emission from occurring in the first place, that's your first priority. In the event that you cannot avoid, or that it's not kind of there's no effective technology for avoiding its source, you can move to collection, which is capturing those emissions, and in some cases aggregating them with their smaller emissions, and finding a potential reuse, which is priority 3, where you can reuse or concentrate them or use them for fuel is quite a common solution. If you have good quality methane that doesn't require a lot of additional conditioning, it can be used for fuel gas, for microturbines, for gas engine generators to generate power, for example. And if you have significant volumes which you can aggregate, you can look at potentially monetizing for alternative product streams. That's technologies such as gas to liquids or compressed natural gas, or other means by which, when you have large volumes of methane that have been aggregated and collected together, this kind of harks back to the early example I gave of using common facilities. If geolocation suggests that that's an appropriate solution, you can then bring together several sources to monetize it through a common facility. Finally, the kind of least favored priority or the lowest priority is to dispose or convert the emissions, i.e. combust them through a flare to reduce the overall impact. Flare combustion efficiency is usually about 95% minimum. So you can reduce that global warming potential, but it's obviously your last option. If you can collect, reuse, avoid, or monetize, that's much more favorable. So we use this tool to understand which solutions could be applied to the various assets when we have the forecast in place as well. And we assign it to the particular emission type. And identifying those solutions is based on a number of factors, such as the asset complexity, whether there are standard equipment sizes, whether there's a need for power, whether there is practical limits, whether there's economic limitations. So what we go through with the technology selection criteria is when we look at those 5 priorities, we have some governing criteria such as flow rates or complexity or age of facility to help guide us on which solution could be applicable for the asset for each of those priorities. And we've tools developed to help us with these technology selections. Here's some typical examples. I'm sure you're familiar with some of these, if not all. So leak detection and repair is the cornerstone of any methane emissions abatement. It's the kind of minimum effort that should be made as part of your surveys, is also repairing. Vapor recovery units in the middle row there is very common as well to be used for tank vented emissions. For microturbines can be used for gas that's recovered. Even small flow rates can be used to generate power. With larger emissions sources or larger volumes, you can use alternative fuels. Example here is a small scale compressed natural gas. You can use predictive maintenance to avoid stop at source. And as I said before, kind of priority 5 is just a typical gas flare. So these are kind of the solutions, the typical solutions that you might use for the asset. So we've now got our assets mapped, we understand the location, we forecast the emissions, and we've identified technology solutions. So then we come to the kind of crux and the main point of this presentation, and that's around your technology cost estimation.
And Bobby, maybe before jumping into the
Sure.
further slides and to let you breathe a bit because
Thanks.
you're the only presenter today. I just wanted to somehow check with you, although I'm half sure in the answer, because it looks great, this methodology at the beginning, even if company doesn't have own data, own measured data on emissions, so this can be assessed.
Correct, yes.
And then all costs further on can be, of course, then compared and picked up. And then the same goes with this priority criteria. For example, in European Union now there are already some obligations from the regulations, so they also can influence, of course, priorities and which place it's really no-go avoiding emissions or finding another solutions. So it seems to me that it's really fit globally and fit for particular cases where companies already have measured emissions and when they have predefined priorities for solution. Let's put it that way.
Yeah, that's very well put, Carolina. Part of it, and I probably glazed over it quite quickly, part of the methodology is to look at the relevant company objectives and criteria, as well as the national regulations for the countries in which they are operating, the countries where the emissions are generated. So that kind of, desktop analysis is conducted in the first phase, in phase 1. So as part of the discovery, as well as understanding the emissions and the locations, it's also important to understand the context. What are the drivers from a regulatory perspective? What's the national energy strategy? What's the limitations? How does it work in terms of the block, if they're in the EU or if they're in another block? So yeah, No, very well stated, Carolina. It's the idea is that it's flexible and scalable.
Thank you.
Okay, and thanks for the break as well. So, talking about the technology cost estimation, so there's kind of two levels. At the very first initial level, you need to do what I would call the concept selection level of cost estimating. So, to estimate capex at concept select level, it can be done relatively quickly, but it needs to be kind of on a consistent basis. So again, we've developed a method by which you're applying the same approach to each of the different technologies so that you're bringing them up at a common level. So that's what I would call a building block approach. So rather than looking at detailed equipment items, you don't have that level of maturity yet. So Doris has got a lot of experience from doing these kind of projects for the last 60 years, as I mentioned. So we've got a big project database, but there's also a lot of industry analogs out there as well that help you estimate the base capex, okay, for this flow rate or for this number of tons recovered. This might be a typical factor that is used. Excuse me. The important part then is to index it, factor it, and scale it. Now, few words there. What do they all mean? Indexing means ensuring that when you look at the application of that particular technology, you're using the right kind of flow rate or governing parameter, whether it be pressure or flow rate or age of plant, to make it relevant. Factoring, typical factors that we might use are things like location factor. If you're looking at an industry reference from the US and applying it to the EU, there may be a location factor applied to it because it's very different from the Permian Basin as it is to the Norwegian continental shelf. They're quite different from onshore to offshore. There can be factors that are required to ensure that whatever the basis you're using is applied appropriately. And you're not just taking a figure from literature or from a previous project and applying it without considering how you're going to use it, which is why we spend so much time in the first phase around understanding the emission source and understanding the asset. Because when it comes to applying any factor, you need to know from what basis you need to apply that factor to. And scaling, again, is around the size of the unit or the size of the technology, dependent on the emissions volume estimated. Emissions recovery factors. So we've got ranges for each technology. We've done comprehensive research to understand what the upper and lower limit is. And we will look at those and work with either company or ministries or whoever is the key stakeholder to understand how they think the technology can be applied and what a realistic recovery factor is. And it's really important. The recovery factor is so important when you look at 25-year life cycle cost, because you'll have a shape of a curve that says, dependent on the technology, that you can achieve this maximum recovery factor within this time frame. Initial capex spend, you achieve the recovery factor, and then all of a sudden, you've cut a wedge out of your emissions, and that wedge or reduction in emissions has a value, either as a sold gas or recovered for power, or however you want to, carbon tax is a whole load of ways that it can be applied. And solution modifiers are also applied. So therefore, supplementary equipments or logistics or duties or specifics in the country of installation. So as I'm showing in the right, those kind of those factors are things such as the estimated emissions rate, the redundancy. So redundancy meaning, do you need to have 2 by 100% of this technology to meet certain availability criteria for your own company perspective, or are you happy to have 1 of 100% because it's a decarbonization project and there's no production associated with it? The recovery factor, as I mentioned, and then also the total installed cost estimate will rely on industry metrics. If vendors have published data, DORIS project database, and location allowances include labor costs as well as published factors. So that's the first stage, that's concept select. Now, as you've moved, so you move through concept select, and usually we find after we've done some modeling in the concept select phase that there'll be some obvious preferred options. There'll be something that falls out of there and clients or stakeholders are keen to understand more about those particular solutions. And that's where we bring some of our engineering know-how. So we move from concept select, where you've gone very high level and you're using kind of, either our in-house data or industry published data, to specific concept definition level CapEx estimates, so that you can actually screen and select. And in this instance, as you can see on the right, I'm not going to go through the detail of all of this, but we use CapEx estimation tools. So we've obviously got in-house project experience, as any engineering service provider does, but we also do vendor engagement. You support vendor engagement at this point because you should have enough information for them to provide you with some budget pricing, some indication of equipment size, lead time. We use industry recognized calculation methods as well. So we have a few inputs that are absolutely critical here, that's such as the methane content, potential recovery. And once we have all of those, we can start building our capital estimate. The OPEX, or the operating cost estimate, is then based on one of two things. Either we can base it on complexity. There's some standard approaches, if you have low, medium, or high level complexity, how you might ascribe it as a percentage of the CapEx, particularly for these decarbonisation or methane reduction projects, which are usually small brownfield projects in nature. You may get some large aggregated projects, but usually they're quite small brownfield projects. So you can use some, industry recognized metrics for percentage of CapEx, or you can use typical maintenance schedules. A good example for that is a vapor recovery unit. They're standard units. There's thousands of them worldwide. You understand what the downtime might be. You understand your labor cost in the region. You know what the parts and equipment cost is. So you do a very small scale bottom up estimate to give you your annual operating cost estimate. For equipment costing, so when we look at things like microturbines, gas engines, vapor recovery units, we would typically take the approach of trying to understand the base equipment cost through these methods I've just outlined. So vendor engagement, in-house project expertise, etc. And then you would increase those costs using bulk material factors or installation factors. Very standard approach in engineering when you're at this level of concept definition. The next stage, if you're to move forward from here into what I would call early engineering or pre-FEED, you would do multidisciplined engineering design. And that's when you start looking at, what area do you need? Do you need piping? Do you need instrument electrical and control? Sorry, excuse me. And you would actually build out more of an engineering design, an early engineering design, and do specific, discipline-wise cost estimating. So that's the next level, even further than concept definition. But we find that we can do these types of concept definition cost estimates relatively quickly, because we've spent the time in the concept select phase, understanding the technology solution and the asset. We can then move ahead with concept definition with not too much effort. So when we're doing these concept definition cost estimation, as I mentioned before, one of the important parts of it is this technology sizing, because you're using your equipment size as your base cost, and then adding on to this with ancillaries such as piping or cabling or instruments. It's important to get a robust estimation on that base cost. So for that, we use reference data from projects. So that this graph on the top right is just a very quick example of some of the reference data we have, where we put a best fit curve around some closed flare projects that we've been involved in. Or you can use typical engineering principles such as the 0.6 rule, which is when you have a base cost size, equipment size, and you use power of 6 for depending on the changes in flow rate. As I mentioned in the last slide, vendor engagement for budget estimates is really useful for larger projects. We tend to get really good engagement with vendors. I think this is an active field now, methane abatement globally. Vendors see it as an opportunity. And as a result, you tend to get good responses, good quick responses from them, which can help you have a really good solid basis. In the event that you don't have any of this information, you don't have reference data, or you don't have time to reach vendors, there's obviously papers out there. There's a lot of documented industry papers and guidance documents, but a note of caution on those, in our experience, you always need to make sure that you factor or adjust them for location and time. So we frequently see papers published for certain countries at a certain time. And yes, the data can be well presented and can be good and robust. However, if you're going to apply it to a project in a completely different location in 2027, you need to take that into account. You need to inflate, add location factors, and that's really important when it comes to the economic modeling. Otherwise, you do not have a relative basis. Finally, capital phasing. So capital phasing meaning for those kind of larger multi-million-dollar projects, how are you spreading the capital expenditure? It won't all be, instantaneously spread in year one. There will be a ramp up, there'll be a period of engineering and then procurement and then installation. So what does the shape of that phasing curve look like? And again, that's important for two reasons. It will help inform your overall cost metrics, and also helps you understand, or your cost curve, what your expenditure looks like in the initial period, and it also helps you understand when your recovery factor will kick in. What is the shape of your emissions reduction curve? Okay, I'll just pause there for a second, Caroline. I don't know if anyone's got any questions. There was quite a lot that I went through there on cost estimation.
Yes, I would also open the floor for questions from the audience if they have some. I didn't see anything in chat. I don't see raised hands. But nevertheless, it looks from from description so far like this is again flexible for all size of the companies. Let's put it that way.
Yeah.
Globally
Yeah,
or locally, or just having one asset and or company looking at one asset and there to reduce emissions.
Yeah.
And all what you described so far, I would assume that this can be done by the technical staff. I mean, by the staff of the company as such.
Yes, that's right. And part of this is about making sure people feel that they're empowered and that they can go ahead and try these techniques. They're quite, hopefully not too complex principles. I'm hoping that I've explained this in a way people can understand that it's not, it's not too hard to make those cost estimates. And the important part of it, the really, really important part, is making sure that you've got a consistent basis for comparing technologies, and that when you're using reference prices, that you're putting appropriate adjustments on them. And when we talk about this level of cost certainty, where we're sitting, this is, in terms of the accuracy, this is somewhere around the strategic or concept level, is how I would describe it. So I've used those terms, concept select and concept definition. If you look at it from, where you are compared to construction, you're at a much wider range of accuracy. So each of these costs is going to be plus or minus 50% to start with. But what you're trying to do is narrow down as you go. So because it's a relative basis, all the costs have the same level of uncertainty. So when we do this, the maturity of the data is really important. So we can use different, as you mentioned before, Carolina, we can use different levels of data as inputs to the modeling. We can use national methane emissions data from public data sets, or we can use asset level from the company's own OGMP reports. And then for cost estimation, we can use our own database, but for those companies that wish to do it themselves, they can use industry reference metrics. They can use vendor engagement. There's techniques out there that are available. As I said, it sits between strategic and concept, and it's really best geared towards these low-cost brownfield solutions that we're talking about. Ideally, if you want to get the best estimate quality you'll get, is by using results from direct measurement and by maturing your design. The further you mature your design, the further along this curve you'll get and the better certainty you'll get on cost. So we do, as I mentioned right at the start, I think one of the most important things that DORIS does with this kind of information is we do economic analysis. And this is where I would encourage anyone who's dealing with trying to understand the prioritization of methane or decarbonisation is to do a good quality life of field economic model for the technology solutions. It's the best way to be able to really understand what is going to work for you and what isn't, and why. It give you such good insights compared to just looking at capital cost and thinking, oh yes, that's the cheapest and it's the quickest to implement. That's our best solution. By looking at your life of field economics, it takes in all those important parameters. How's the gas price going to change? How does the carbon tax expected to change? How does the production on the asset look and the emissions on the asset look? What's the operating cost for that technology solution? What's the potential recovery of that technology solution? It brings in multi-variables that you need to really put together to understand what are your potential panel of solutions and what should your decision be supported by. So this gives you any economic modeling, and the model we have should allow you to compare the key parameters such as your net present value, your payback, your curve of your expenditure. And what I'm going to show you now is how we've developed ours into a data visualization tool, which you can see here. So an example here, just without naming any assets. So in this particular asset, you can see on the bottom curve here. So this is the initial expenditure for a vapor recovery unit. In the first year, you're doing engineering, probably a bit of procurement by year 2. And the curves here you can see, so that's your baseline emissions shown in light blue. And then once you've implemented the solution, there is your remaining emissions. So it has a big impact. There's your overall CapEx. And the revenue that's calculated here for this particular example, it will change for each company, each asset, each person that's doing it. This was based on the inputs on carbon tax, on forecast gas price, forecast oil price. Shutdowns are incorporated in here as well. So you get your overall revenue curve here as well per annum, which can really help. These kind of financial models are very useful for the finance people in most organizations. And an example here shows when you've got something combined like LDAR and VRU. So you can see the case costs initially are quite high, but by implementing VRU, you're effectively paying for your LDAR campaigns in future. This shows the negative revenue here basically or negative costs means it's positive revenue. So you're making money as the time goes on. And in some of these cases with the combined solutions, very high baseline emissions, estimated just under 60,000 kilotons per annum. Over the life cycle, 60,000 kilotons over the life cycle, and you're recovering 33,000 with a potential revenue of $240 million in that instance. So you're comparing these, as I said, you're comparing these assets and on a consistent basis, which allows you to support your decision making. It's really quite an important part of bringing those costs together. That's VRU example again. And I think I had a couple of LDAR cases here as well. And you can see the difference in the LDAR here. So we've kind of assumed in this case for this particular asset we were looking at that it was an aging asset. And in the do nothing case, there was a slow increase in emissions. So if you do nothing to an aging asset and it already has leaks, chances are you're going to have more. There's going to be more leaks, and in this instance, it was kind of a linear trend that we predicted. However, if you implement an LDAR program, you're likely to reduce those emissions, but will you be able to reduce them faster than the rate at which they're increasing? That was the kind of test, and that's what this graph shows with the remaining emissions. Nonetheless, again, case cost positive. You can see the implementation of the LDAR campaign on these 4 assets shown here had a potential revenue of $500 million over the next 25 years, so not insignificant. I think most people would be familiar with MACs as well. Now, MACs are useful. They're a good comparative representation, and I think most people would be familiar with how they work. For those who aren't, the The size of the line is the emissions cost in real terms and cost per ton, US dollars per ton. Negative being that it's generating revenue, positive being that it's costing money. And then the thickness of this particular bar is the amount of emissions that that particular solution has abated. So another good way to look at it, the colors representing different assets and technology solutions in this instance. However, I think it's useful, but it's pretty limited. It's not as good as a detailed economic model like the one I just showed you, because that allows you to kind of really dive into asset level solutions and understand the drivers around cost, around OpEx, and around things like gas price, carbon price, recovery factors. So final slide, just in conclusion. So what I'm trying to suggest is that having a repeatable methodology and a consistent methodology, it gives you the opportunity for comparative assessment. The risk and what we've seen people doing is you have different business units or different asset owners who might have different criteria they use to assess their projects. It doesn't give you a full level playing field across all assets or across all projects to make informed decisions. It's really important to have a consistent approach and a standardized approach. The more granularity you have in your emission sources will help with your technology selection. That's pretty obvious. You know, if you've only got an estimate at asset level, then it's very hard to pick a technology solution. But if you've at least got it to level of fugitive emissions and tank venting and combustion emissions and flaring emissions, already you've got a reasonable starting point. So any granularity on emission sources will really help. And that's where OGMP really helps a lot. It helps to bring participants down that path. A building block approach for concept level cost estimates. Make sure that you think about the quantity of the emission and the installation location. So that methodology I was showing you of having a building block approach with concept level costs and layering it with different factors or indices depending on the emission volume and depending on the location, really make sure that you bring all those considerations into play. So we recommend, as I said before, if you're using concept select cost estimates, use indexed factoring and scaling, which will help you screen and select your technology. For concept definition, industry data is available, vendor engagement's useful, but you have to really think about the size of the technology and the location. You know, where are you installing it? Onshore, offshore, logistically challenging, what's your labor costs like? They're really important elements. The risk of using max or industry data is it's not one size fits all. I want to be really clear about that. Even in the EU, there'll be differences between offshore, onshore, differences in location between urban areas, remote areas. All these things have to be considered. Total installed costs, which is kind of the premise of you know, the concept definition or the concept select cost estimates, they'll get you to total installed cost. That's just the starting point. Ultimately, you want to do economic modeling. You want to have enough of a view of the life cycle cost to make informed decision making. And you need to know what the key assumptions are to do this. And it's okay if you don't know them. There's published data available and you can do scenario modeling. That's what economic models allow you to do. You can do sensitivity analysis, you can flex, you can say, okay, I don't know what the carbon price is going to be in 10 years, but I can do a high, a mid, and a low scenario. And all of those will help to inform your decision making. And look, that's as much as I had to share. Thanks very much to everyone for their attention.
Thank you very much, Bobby, for keeping really this lot of data, a lot of slides, and in high tempo of speaking and then explaining everything. We have one question in chat, so if Oleg, you would like to unmute yourself and put the question, it's fine. If not, Bobby, and I mean, we can read it anyhow.
Yeah, sure. I'll read it out. So regarding data acquisition on costs of equipment and location factors, how is this usually sourced from which authority stakeholder? So data acquisition on cost of equipment, it really depends on the equipment type. if I give you an example, a vapor recovery unit, quite an established means for reducing tank emissions. There's a lot of internationally published, industry published reports. So places like the US EPA, they've published a report on it, and you can do some online research. For location factors, there's companies such as Atkins, Faithful and Gould, Compass, I think as well, where they publish location factors on an annual basis. They're usually used for very large developments, but they're just as applicable, they're just as useful for these smaller decarbonisation projects. Does that answer your question, Ole?
Yes, yes. Many thanks.
So more questions, but I don't see raised hand. I don't see text in chat. Maybe until people are still thinking, two questions crossed my mind actually, and one was related to, do you recall maybe in your experience and work with clients and with many countries and companies, the examples when somebody would say, yes, we did it assessment, but actually this is not cost effective because it's still better to emit whatever we emit than to go into investments.
Definitely, Caroline. It's a challenge, and particularly in locations where there is not a rigorous regulatory regime or carbon tax. It's a competition, it's a capital competition. So an operating company will say, well, why do I need to spend money on this waste disposal project when I can spend the same money increasing my production? And it's only when you have either firm regulatory regimes in place or stakeholders, their shareholders pushing them and saying, oh, look, for bigger companies, that's what you tend to see. For bigger international oil companies, they have certain commitments that their shareholders expect them to meet for methane emissions reduction targets. But yes, I've definitely seen that come up, even when you can demonstrate that the payback might be 5 or 6 years. You're comparing that to a project where they may have payback in a year or two for a production project. So you're competing. The capital competition is there, which makes it challenging. That's a very good question. And yes, I've seen it. Yeah.
Yeah, and I can imagine this also depends on the at the end price of natural gas.
Yes. Yeah. And so, yeah, in some countries where it's heavily subsidized, where we've worked as well, there just isn't the economics in recovery of the natural gas. But in those instances, you can always look at alternates. So another way we've helped people to look at this problem is to say, okay, if you don't want to sell the gas, can you displace your fuel gas, for example? So already you're using gas on site to generate fuel for your gas generator, your turbines, your micro turbines, whatever equipment they might have. So instead of using all this fuel gas, use recovered methane instead. And then, it kind of, they see it as a saving, they see it as a potential benefit, and they put a value to that as well. So we always have to look at another way to approach the problem.
Yeah, but combination of proper policies in place and then commercial issue in all.
Yeah.
Yeah.
Yeah, the commercial issues is probably one of the bigger challenges, because there's not a universal approach to carbon tax. There's not a global approach to it yet, and as a result, countries can differ widely. There can be a big difference in what the value is of recovering and reducing your greenhouse gas emissions.
Yeah. Thank you for putting these insights all together. But I have another question I can see.
Yes, thanks. So, Bobby, you explained perfectly this bottom-up approach, very technical and with a lot of engineering details. How it adds up to like high level estimates of like basin or country level estimates, and does DORIS produces such like modeling or scenarios, and how do you like achieve this overall assessment and country level estimates from the bottom level data that you mentioned?
Yep. Yeah. Okay. I understand. So what we've found and what we've tended to focus on is that when in that first phase, what I call the discovery phase, when you're looking at your emissions sources and volumes, there usually tends to be quite a clear kind of a clear picture of the main contributors, and that's where you really start focusing. A few examples out. Some countries we've done where you can see the top 3 contribute 67% of total emissions, or the top 5 contribute 80% of emissions. So once you have that picture, it's very rare to say that, there's 30 assets. I've never come across it myself. There's 30 assets that are contributing to 50% of emissions. It tends to be quite a few large emitters that are the main culprits in the oil and gas industry. So you've then got your assets, right? So once you have your assets and you understand those key emitters, the bottom-up approach for a national, a country level, means that you still are addressing the most, the largest, the majority of the emissions, even though you're only focusing on a handful of assets and you're drilling into a few technologies for those assets. So although, you end up being quite small scale and bottom up and asset specific, when you put it all together and you see what impact it has on the national emissions, it's very large.
Seems clear and well addressed. Yeah, you already show actually that this is applicable for all, entire chain of the gas and oil industry. So you just put your assets and then technology and estimation. So being production fields or being whatever distribution.
That's right. Yeah, that's right. Yes, exactly. Distribution network, or production field storage, gas storage, oil storage.
Yeah,
it's completely flexible. Yeah. Which I hope some of the attendees can apply to their own assets as well. They can kind of take some of these basic approaches and some of these methods and think about how they might apply it to their own operations.
Yeah, I hope this as well, because this is the purpose of sharing the knowledge, putting ideas. So last call for questions from audience. It seems not being the case. I don't see any raised hands or text in chat. So with that, we can close, and thank you very much for talking 1 hour almost fully. So we are going to upload the slides and recording as well, and stay tuned, stay in touch. The next Methane Monday will be on 10th of November. So with that, nice afternoon, good night to
Thank you.
Part of the world, and see you in 1 month time.
Thanks very much, everyone. Thank you, Carolina. Bye.
Thank you very much. Bye-bye.
Thank you very much. Bye-bye.
Thanks. Bye.
Bye to all.